You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of The Options Playbook. All righty. Earnings season is waning a little bit. We had a lot of big name stocks, mega caps, announce earnings last week. Made the market quite volatile. If there was anything about the earnings, the moral to the story was volatility. A lot of the mega cap stocks moved more than expected. We looked at a trade in Amazon last week, and Amazon was all over the place. Well, it started out, what created the volatility was a big downturn in Meta, otherwise known as Facebook. And that really drove the whole tech space down overall. Amazon was one of those stocks that got driven down. They were announcing later in the week. We looked at a standard butterfly in Amazon, and we talked about that trade on Wednesday after the close. Amazon announced Thursday after the close. And as always on Options Playbook Radio, nothing's ever meant to be a recommendation. And we don't always get to pick exactly when we're going to be taping the show. The reason why I bring this up is that on Thursday's trading in Amazon, the stock moved more than it was anticipated, more than the expected move on Amazon after earnings. So on that day, we actually saw the Thursday before they announced on February 3rd, the market was down 235 points in Amazon. So the butterfly that we looked at, if you would have waited until the close, would look a lot different than the one that we actually put on. But with that said, that butterfly could have turned out all right. We had a 100-point landing area. We obviously had increased implied volatility. I always find Amazon to be interesting because they always announce on a Thursday. And your Friday expiration, that means you have one full day of trading before all that time premium on that expensive underlying and implied volatility all has to come in. So butterflies are definitely interesting on Amazon specifically because of the day they announced their earnings. So with that said, what happened with Amazon? So on Wednesday, when we set up the trade, Amazon was trading at 3,012. we looked at going about 250 points out of the money on our option contract that we were buying. We were using call options, February 4th expiration. We looked at buying the 3250 strike, 3,250. That's what we're hoping that Amazon could get to, approximately 240 points higher than where it was currently trading. We then went 50 points above that and sold the 3,300 strike, sold that twice, and then went another 50 points and bought the 3,350. So 50 point wide butterfly, 1x2x1, approximately 240 points out of the money. Now, I would have adjusted that trade because you think about it, the very next day, the stock was actually down 235 points, which was kind of the move that we were hoping for to the upside. And that was all generated. Well, it wasn't all generated, but the main reason for the big drop was because of the bad performance that Facebook had after their earnings. So with that said, I might have adjusted it, but the after they announced earnings, then Amazon proceeded to knock it out of the park. And hence, they're a much different company than Facebook. Not quite sure why Facebook drug them down so hard overall, especially when you consider the web services. And that's a bigger part of their company than the actual retail space as far as Amazon is concerned. And so then we saw, since they knocked it out of the park, that it almost got all the way back to where our butterfly, within the sweet spot of the butterfly. So interesting enough, after their announcement, they actually closed at $3,152. The high for the day was $3,224. So we wanted the market to get to 3,250. We paid for that trade $1.60 overall. Now the markets were closed, and that would have been a midpoint fill. So the trade would have been profitable. One day to trade, we saw when it got close to that high, we definitely would have been up on the trade overall, a couple of dollars or a couple $100 for every 1x2x1 butterfly that you did. So if you did put on the trade and you did not adjust it, now once again, we suggest you do it on paper, that trade would have been profitable overall. So very interesting week's worth of earning, very interesting trading overall. Now that a lot of the companies have announced earnings, market's settling down a little bit, but we still see the VIX index elevated up above the 20% level. So with that said, if I'm thinking about what's going on in the market, we have the CPI coming out tomorrow. It's anticipated to be a large number, and it's definitely, the market is a little bit nervous about inflation concerns. We're seeing the TNX, which tracks the interest rates for the 10 years, the CBOE index, is trading at about 1.92%. And so we're bumping up against that 2% level in the 10-year, which is a scary level. That's just a big round number that a lot of people are kind of looking at. And I think that's one of the reasons why we're keeping the VIX elevated. I should, before I get into the trade, let you know that we are actually taping a little bit earlier on Options Playbook Radio. It is Wednesday the 9th, but we're taping with the market open. And we do have the VIX trading at about 2060. The market's moving, so it's down a little bit today. But that makes sense. We have the SPX up, NASDAQ up, Russell 2000 up. So all of the major indexes are up, and we see the VIX down a little bit. But to my point is that I really am surprised to see that we're still up, or I'm really am surprised to see that we're as close to the 20% level. I'd actually expect the VIX to be a little bit higher with the nervousness and the CPI report coming out tomorrow and everything that goes along with that. Okay. So with all that said, I'm going to look at a trade because I think the marketplace is trying to figure out where it wants to go next. So I'm going to look at more neutral trades. We've been very bullish overall because the market in general has been bullish. So a lot of the paper trades that we've looked at over the last year have been to the upside. So we're going to look at a bullish to neutral trade, and that's a short put spread. Now, we've talked about short put spreads. We've done hundreds of shows here on Options Playbook Radio, but it's kind of fitting the forecast. We're going to look in the SPX. The NASDAQ index, as far as the chart is concerned, looks a lot uglier than the SPX, but it's also important to note that in the SPX, we have between 26 to 28% of it made up of tech stocks. So even though the SPX isn't necessarily the NASDAQ, then one of the biggest percentage of a sector is actually represented inside the SPX. So I'd rather do it in the SPX just because I think that it's a little bit more stable at this point in time than where the NASDAQ is at. And we're going to be selling a short put spread. So how do we set up that short put spread? Well, first of all, if you have not traded in the SPX index, you do want to look at a few of the nuances. They have weekly option contracts, and they also have the normal monthly option contracts, which actually stop trading on Thursday, where the weeklies stop trading on Friday. There's a difference between AM and PM settlement, so I'm going to draw your attention to it. I'm not going to go into great detail, but if that sounds confusing to you, you're going to want to research that before you consider trading in the S&P 500 index. And also, we're going to go out we're going to use the weekly contract that trades all day on that Friday expiration. We're going to go out 28 days. The market right now is at 45.72. I'm going to round off a little bit, 45.72, up about $50.45. As I said, the market is moving. I'm going to start by looking at what is the expected move. If I'm looking at the February 28th expiration, what is the midpoint of the long straddle? That means we buy the put, we buy the call. At this point in time, that's trading at 135. So that is about what the marketplace is anticipating the move. Could be the upside, could be the downside. Never has regard to direction. And if I'm looking at that, I want to go quite a bit out of the money, especially on the put side of this trade. And because the VIX is so high, well, it's not enormously high. I don't mean to imply that it's extremely high, but since the VIX is up above 20, there's a lot of premium that are in these option contracts. So we're going to actually go all the way down to the 4,300 strike. I always like to use nice round numbers when I can here on Options Playbook Radio, since we do not have graphics and we're all sound. So in this instance, we're going to look at the 4,300 strike. We're going to go 10 points wide, and we're going to buy the 42.90 strike. So 4,300 strike put with the February 28th expiration is the one we're selling. And we're going to be buying the 44,290 strike put as our protection. The spread is 10 points wide, means the maximum it could trade for is 10 points. And right now, the midpoint of that trade is a net credit of 80 cents to the account. Now, when I looked at it, market was a little bit different. I brought in about $1, and that's usually my goal if I'm going to do a 10-point wide spread. I'd like to bring in $1 overall, but we're going to ride with this one at 80 cents. That's going to be our paper trade for this week. So that means for every 1-by-1 spread that we do, we're going to bring in $80 less commissions on that trade. The maximum that we could lose on the trade would be $9.20 or $920. We are quite a bit beyond the expected move on this trade. So if we look at the actual delta of the option contract, that will give us a little bit of a hint as to what's the probability of the underlying finishing below that strike on the expiration date. And our delta is pretty low overall. We're looking at about a 6 delta on the 4,300 strike, which means that we have about a 6% chance of it reaching that strike price by that expiration date overall. All right, so high probability of success, but then again, that's not an exact science, so I want to emphasize that. But it does give you some idea. We're talking about an expected move of 135 points, and we're going to be going from 45.71 down to about 271 points out of the money on that trade. Right now, the market is up about 1%, which is around 50 points on the marketplace, just to give you a feeling for how much 270 points are. We're going to have 19 days until that expiration date. And my goal here, whenever I sell these option contracts, is to try to make at least half of the credit. We're receiving 80 cents. I would consider getting out at around the 40-cent level. Now, if the market continues on up, we're neutral to bullish. Well, I might consider letting the trade ride. I feel pretty comfortable about it. Normally, I will close out the trade if it ever gets to 5 or 10 cents on an SPX short spread. I'm going to want to close that out. I really don't like the risk of being in that position for just to try to salvage the last 5 cents. So that's my general rule of thumb on it. The market moves against me and I'm down about 80 cents on the trade, the maximum that I could make. That means I would be trading for about 160, and then I would look to close out the spread and move on overall. Now, SPX is an index, and that kind of dampens volatility a little bit as opposed to just doing an individual stock outright. 19 days in the SPX is a lot of time premium. I really don't want to be in it the entire 19 days. I'm hoping that I can get out with around 7 or 8 days remaining to the expiration. I just don't like to be in short spreads at expiration. And if the market goes hard against you, they hurt you because of the explosiveness of those option contracts overall. So I'm kind of hoping that. Now, if I was an individual stock, which I did actually talk about on the stock play of the day, which we do on the Ally YouTube channel every Tuesday at noon Eastern time, we looked at an individual stock. Netflix was the underlying stock, and I went out 45 days, and I gave a detailed explanation on that webinar as to why we chose 45 days for the Netflix, where here we're going to do 19 days for the SPX, which is an actual index. So the difference has a lot to do with the value of the underlying, the amount of volatility that's in the underlying, et cetera, et cetera. All right. So let's recap. In the short term, we're neutral to bullish on the marketplace. So we tried to come up with a trade that would fit this. We'll be looking at maybe a couple of iron condors going forward. We're going to do a couple of these premium selling trades, and it's very interesting to me with the VIX around 20. But I'd rather trade the SPX with the VIX at 20 than the VIX at 10. I like the fact that we have a little bit of premium. It gives you a little bit more flexibility on your trade overall when you have a little bit higher implied volatility. We're going to look at the February 28th expiration. We're going to sell the 4,300 strike put, and then we're going to buy the 4,290 strike put, looking to get it done at a net credit of 80 cents to the account. And as always, when you're looking at these trades, you want to have your plan, you want to have it set up, and then you want to stick to your plan. And that is the whole concept that's behind Options Playbook Radio. And that will be it for this episode of Options Playbook Radio. If you would like to learn more about all of the educational offerings at Ally, please check out my Twitter. My handle is very simple. It's at Brian Overby. You can also email me directly at theoptionsguy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.